Namaskar dosto, welcome back to Dhwaj Stock Info. Today we are going to discuss one important subject, how to read the cash flow statement. The most honest financial statement, no tricks. No tricks, the most honest financial statement, no tricks, just a cash. The balance sheet, episode 12, we learned where the company stands. Assets is equal to liabilities plus equity. Then comes the profit and loss account statement. In episode 13, we learned how the company performed revenue to profit after tax journey. Now the cash flow statement. In episode 14, today we ease the money real. Cash in and cash out, the truth behind the numbers. Let us start the video and request all the viewers to please watch in full without skipping so that you will not miss the important points. In this section, company A and company B, we are going to analyze maximum visual drama at the opening. Let me show you two companies from this quarter 4 result season. Company A reported a net profit of 100 crores. Its cash flow statement shows 130 crores of the operating cash flow. More cash came in than the profit shows. The company B reported 100 crores net profit, but the cash flow statement shows negative of 20 crores of the operating cash flow. The company reported profit but actually lost cash from its business. Same reported profit, company opposite financial realities. Which company would you trust with your money? Company A, every single time, and only the document that reveals this difference is the cash flow statement. In episode 12 and 13, we have studied the balance sheet and the profit and loss account. Today, in episode 14, we complete the trilogy with the most honest financial statement of all. After this episode, you will never look back at the profit number in the same way again. Now, company A, trust this. Net profit is 100 crores, operating cash flow is 130 crores. OCF above profit, real cash confirmed, quality earnings, trust this profit. Company B, question this. Net profit is 100 crores, operating cash flow is equal to minus 20 crores. OCF negative despite the reported profit, ghost income, investigate urgently. The next section will discuss why cash flow is different from P&L. Real money versus accounting opinion, the core distinction. Why does the profitable company sometimes have a negative cash flow? Because profit and cash are not the same thing. Profit is calculated using accounting rules that allow revenue to be recognized before the cash is actually received. A company can book 50 crore sale, show it as a profit, but the customer has not yet paid, the cash has not arrived. This is called the accrual accounting. The cash flow statement cuts through all this. It tracks what was actually cash moved in and out of the company's bank account. Real money, physical rupees. Warren Buffett has said the best accounting earnings are opinions. Cash flow is fact. The profit and loss account tells you the company earned. The cash flow statement tells you what the company has collected. One is an opinion, the other is a bank statement. In short, 22 I have introduced operating cash flow. Today in episode 14 we go the full depth of all the three types of cash flows. Operating cash flow, heartbeat, the most important sections. Screenshot this before the formula table. Operating cash flow is the cash generated from the company's core day-to-day business, not from selling assets, not from borrowing, pure cash from the actual operations. The formula starts with a net profit and makes three critical adjustments. First, add back depreciation. This is the non-cash expenses deducted from the profit and loss, but no actual cash left in the company. The second adjustment for working capital changes. If debtors increased, cash did not come despite the revenue being recorded. If creditors increased, you used the supplier's money to fund your business. Third, adjust for taxes actually paid in cash. The result is operating cash flow. This is the heartbeat of the business. Strong and growing OCF business is genuinely healthy. Weak or negative OCF with strong P&L profit, the earnings are accounting fictions. Awfis Space PAT up by 106% today. If the OCF also grows strongly, that is the genuine quality confirmed. Then operating cash flow formula. This is education example only. Net profit from profit and loss statement, episode 13. Amount is 100 crores. For this, you have to add back depreciation, non-cash expenses of 20 crores. Then you have to make following working capital adjustments. If trade receivables increase, deduct cash not yet collected, rupees 15 crores. Then if the inventory increased, deduct cash tied up in the goods, rupees 10 crores. If trade payables increased, add back suppliers money, that is 5 crores. Then deduct tax actually paid in cash during the year, that is 25 crores. Now we will arrive at operating cash flow. The heartbeat is equal to 75 crores. Like this, you have to do this. Then in this next section, investing cash flow, the ambition we'll discuss. The ambition room, growth versus stagnation, life Suzlon example will take. Investing cash flow shows how much the company is spending on its future. This includes buying new factories, acquiring other companies, purchasing plant and equipment. Most growing companies have a negative investing cash flow. This sounds alarming, but is often very positive. In a company like Suzlon Energy with a 5,892 megawatt order book for Q4 FY26 spends on a wind turbine manufacturing capacity, that is a negative investing cash flow. But those plants will generate operating cash flow for decades. Negative investing cash flow is the company saying, I believe in my own future enough to invest in it. The key question is, the company is sending capex from its own operating cash flow, or it is borrowing to invest. The company is spending its own earnings on growth is healthy. The company borrowing money to invest with generating insufficient OCF, that is where serious trouble begins. Then the investing cash flow, the key components, purchasing of property, plant and equipment capex is a typical signal is negative. Then proceeds from the sale of assets of the investment, the typical signal is positive. Then acquisition of other companies, the typical signal is negative. Investing cash flow, the ambition is equal to typically negative for a growing companies always. This sort of keep in mind. Then in the next section, financing cash flow, the structure we'll discuss. The bank office room, debt and equity management. Here comes the financing cash flow, shows how the company manages its funding stake structure. Cash inflows here include borrowing new loans and issuing new shares. Cash flow include repaying existing loans, paying dividends to shareholders and buying back the company's own shares. The company with a positive financing cash flow is taking on more debt on issuing equity. This can fund high return growth, or it can signal the company is borrowing just to stay afloat. The company with a negative financing cash flow is repaying debt and returning cash to shareholders. This is usually a sign of a financial maturity and strength. It means the operating cash flow is so strong that the company repays debt and pays dividends simultaneously. This pattern is the ultimate sign of financing quality. Your goal is company using debt as a tool for a growth or as a lifeline for survival, you have to see. Then financing cash flow, key components. Proceeds from a new bank loan taken means it's a positive inflow. Then repayment of existing loan means a negative outflow. Always you have to check all these points by points. Then dividend paid to shareholders. What does it mean? It's a negative outflow. Then financing cash flow, the structure is negative. It's a sign of financial maturity always. In the next section we discuss free cash flow, the holy grail. Your most powerful concept, write the formula, that is what BT5, that is what sufficient. Now I teach you the single most powerful number Warren Buffett uses to evaluate any business, free cash flow, and it is simpler than it sounds. Free cash flow equals operating cash flow minus the capital expenditure, OCF minus capex. FCF is the cash that remains after the company has paid all the operating costs and invested in maintaining the growing its own business. This money that is genuinely free, the company can pay dividends with it, buy back shares, pay own debt, make strategic acquisition. The company that generates consistent and growing free cash flow is a machine. that prints money for the shareholders. In this Q4 FY26 results season, always look for the companies where the FCF is growing alongside headline profit. That combination is the most eligible real growth credit creation signal in all of the fundamental analysis. Now, the free cash flow, operating cash flow minus the capital expenditure. If OCF is equal to 75 crores and the capex is 30 crores, then free cash flow positive rupees 45 crores. That is excellent. If OCF is 75 crores, capex is 200 crores, then the FCF is negative 125 crores. Check if the growth is driven. Positive FCF growing, surplus cash after all the needs, can self-fund the dividends and debt repayment. TCS, Infosys, quality. Negative FCF growing companies investing heavily in the future capacity. Negative today, but capex generate OCF for the decades. Monitor carefully. Negative FCF, poor quality, borrowing to fund the negative operations. OCF, weak business model not generating real returns, serious red flag. Now, what you have to see here is there are 5 red flags and 3 green signals that are coming. Now, we'll discuss and I'll show you the patterns professional analysts use to spot the financial trouble before the stock price crashes. This section will change how you read every quarterly results. 5 red flags and 3 green signals. Screenshot this before the table. Most shareable section. From 30 years of evaluating company financials for the commercial banking decision, these 5 red flags appear in every company that eventually faces the crash crisis, and these 3 green signals appear in every company that creates exceptional long-term wealth. Screenshot this carefully. The red flag, the first red flag, OCF negative while PAT is positive. What it means? Ghost income. Profit is accounting, not real cash. Highest danger signal. What is your action? Walk away immediately. Then the next red flag. Number 2. OCF below PAT every year. Gap widening. What it means? Company collecting less cash than the profit shows. Receivables building up. What is your action? Check receivables growth versus revenue always. Then the next red flag, number 3, investing CF shows large assets sales repeatedly. What it means? Signaling assets to generate cash, maybe funding operating losses also. What is your action? Is it strategic for survival? Next red flag. 4. Financing cash flow shows relentless new borrowing. What it means? OCF not sufficient. Funding operations with debt trap forming. Your action. Cross-check DE ratio from the short 21. Then the next red flag. Number 5. FCF negative for 5 years. No capex justification. What it means? Business model not generating real returns. Destroying value. What is your action? Exit or avoid it completely. 3 green signals. The cash flow of a wealth creating company. Screenshot this. Green signal number 1. OCF consistently above the net profit. Every rupee profit is backed more than a rupee of a real cash. The gold standard TCS and Infosys pattern. Then the green signal 2, growing free cash flow every year-on-year basis. Surplus cash after all the capex needs. Company self-funding growth, no dependable on banks or equity market. Then the green signal number 3, financial CF negative, debt repayment plus dividends. OCF so strong that the company simultaneously pays loans and pays shareholders. Ultimate financial maturity. Next, in the next section,
friends, now I will show how to check the cash flow in the screener.in. Go to on Google browser, type screener.in. This screen will appear. Then on the search for a company column, type whatever the company name you want to search and press enter. This company will appear here. The summary, you can see the summary of the company here. Market capitalization, current price, high and low, during the year, dividend yield, etc. You can see. Then what you have to do is the cash flow. You have to check the cash flow. Click on the cash flow at the top. The second step, you will see the cash flows. Please check, there are three types of cash flows: cash flow from operating activity, cash flow from investing activity, and cash flow from financing activity. You can see all these cash flows. The third step, check whether the cash flow is positive for the operating activity for the past 5 years. Here in this company it is growing for the last 5 years. Then check in the next step, check whether the investing activity means capex, they are spending the money for expanding their business, acquiring some business, or expanding their business, or expanding their agencies, everything. The investing activity, it is related to all those things. So if it is minus also, no problem, it is the correct thing only. Don't worry about the minus. See that the figures are increasing. And in the next section, see financial cash flow. Financial cash flow, last 5 years, company, whatever the amount spending may be for payment of dividends and buying for their own shares, whatever the funds they are having through which they are buy the shares. That is next step. See the net cash flow. Net cash flow is whether it is positive. After investing all this, whether it is positive or negative, you have to check. Free cash flow. Then the free cash flow, taking into all the things above into consideration, you can see the free cash flow. FCF, free cash flow, is 21,077. This also going in the last 2 years, it is last 3 years almost it is growing only. And the total CFO and OP cash flows are, you can see that 100%, almost near 100%, which is very good for the company. Like this, you have to check your company in the screener.in. Thanks.
Discuss the action steps, call to action, what you have to do it immediately. Warm day, warm energy close always. Your 4 action steps for today. Step 1, open screener.in, search any company you own, click cash flows tab. Is OCF positive and growing for the last 5 years? Step 2, is OCF above the net profit for the most of the years? Then yes means quality earnings, no means investigate immediately. Then step 3, calculate FCF, OCF minus capex. Positive and growing means the company is generating real surplus cash. Step 4, check the 5 years direction, no, not just 1 year. Is the trend improving or deteriorating? Comment below and tell me which company you have checked and what the 5 years OCF trend was. I read every reply, every single comment every day, and I have an existing announcement. Episode 15 is coming, where we will bring all the 3 financial statements together in one complete company analysis, balance sheet, profit and loss, cash flow, all 7 fundamental checks, one company, one complete picture. See you in the episode 15. Please subscribe, like and share with your family and friends. Enrich their knowledge. Give your feedback in the comments. I again remind you to support me by subscribing to my channel. Enrich your knowledge. And finally, thanks for watching.